Today, we've got a great panel on ethics for you. We're going to talk about codes of ethics and best practices for monitoring, testing, administering, and enforcing the policies. So there's going to be another ethics session tomorrow from 11 to 12 Eastern, and that will focus on material, non-public information, and restricted and watch lists and whistleblowing issues. So please come back tomorrow for that panel. I'd like to ask everyone to introduce themselves quickly. I think most of you know this crowd, but Gretchen, why don't you start us off?
Good morning, I'm Gretchen Lee. I'm the Chief Compliance Officer at Clifford, Swan Investment Counselors in Pasadena, California. We have approximately $3.5 billion AUM, and we have 30 employees, just to give you an idea of my perspective when I'm speaking to some of these great ethics items that we'll be covering this morning. Welcome. It's kind of different not to be on the East Coast.
Great, thank you. Kurt, would you like to go next?
Sure. Good morning, everyone. Kurt Wachholz from National Regulatory Services. I'm an executive consultant as well as the Director of Education. We co-sponsor two professional designations with the Investment Advisor Association, the IACCP and IA Core programs, and there's information I'm sure available during the conference for that. Been in the industry 30 years, started out in banking, to broker-dealer as well as investment advisor space. Was an owner of firms from 5-person firm up to 48-person firm, so I'll try to provide some context as it relates to that as well.
And Kevin, I don't think you need much more of an introduction because everyone knows you, but please take a minute and give us a little more information about you.
Well, thank you. As with Gretchen, we're based in Pasadena, California. So Western Asset is an institutional fixed income shop. We've got a little over, I think, 400 something billion in AUM, but a little under 1,000 employees globally. But as Gretchen also mentioned, some of the perspective of where we come from, I think, is helpful when we get into ethics issues and where the overlaps and conflicts are. We'll talk more about that, but as a fixed income shop, some of our conflicts might be a little different than yours. So worth just putting some of that little background out there.
Great, thank you. And I'm Sara Crovitz. I'm a partner at Stradley Ronon. I provide advice about investment advisor issues and investment company issues. And before I was at Stradley, I was with the SEC for a really long time, over 21 years. So I bring a little bit of that regulatory perspective. So with that, we are going to move on to our agenda. At the outset, I want to invite people to ask questions during our conversation. We're going to try and answer them as best we can. The technology is a little complicated, and we'll do our best to be able to watch the questions and answer them for you all. Our agenda is to do a quick overview of the rules, and then we're going to talk a little about the structure of the code, discuss who is an access person and some discussion around how you update that, and then talk about some current key issues that we're seeing in the industry. So first, a very quick outline overview of the rules. In general, Code of Ethics rules at a very high level require standards of business conduct, reporting and review of access person personal transactions to help mitigate conflicts, and generally educating employees about their responsibilities. And I'm going to leave it there for now, and we'll get into a lot more detail as we go through. So the first issue we're going to talk about is the structure of your code. And we'd like to ask a polling question now and get your involvement and input. The way this is going to work is we'll ask the polling questions. It takes a minute for them for the results to sort of collate. And so while we're waiting for the results to collate, we'll go ahead and have a conversation, and then we'll come back to the results at the end of our discussion of this topic. So the first polling question, does your firm's code of ethics include your firm's gift and entertainment policy? So while we wait for those results to come in, we're going to talk about pros and cons of including and not including other things that are not technically specifically required by the Code of Ethics rules. So Kevin, why don't we start with you? What are your thoughts about including things like gifts and entertainment or other non-required items in your code?
Yeah, this is always an interesting question because on one hand, there's an intuitive common thread of personal conduct or conflict type questions, policies, and if you can package them together and broadly describe them as a code of ethics, that makes it easy to describe them. It makes it easy to train your staff and saying, these are all the things you need to know about right here. These are all your ethical, personal conduct things. You can kind of put them in a nice little bucket, and it makes it easier for organization. And that might work for you, depending on your shop, depending on your staff and education and training and business model. That certainly is a viable approach, and some people have adopted that approach. Another question is, as Sara said, there is a technical aspect to the code of ethics, and if you really go back to the source of authority and you go back and read 17J1 and 204A1, you'll see that those really are focused around personal trading. They're really not focused on other types of conflicts like gifts and entertainment. So you don't have to be a lawyer to appreciate terms of art. So if you're going to call something code of ethics, and the SEC has called code of ethics things that are associated with personal trading, there's kind of a common naming convention there that we can all use and know what we're talking about. So there's a little bit of a common sense or an intuition there as well, that you follow the source of authority. There are some definite implications of that, though. So, for example, if you manage money for mutual funds, mutual funds under 17J1 are obliged to review and approve code of ethics. So that means if you want to change your code of ethics, you need to work with your mutual fund clients and go through a board process. So there's potentially some logistics, some friction involved there if you wanted to change your code. If you don't manage money for mutual funds, then maybe that's not such an issue for you. Another aspect that jumps up periodically is sometimes clients want to know about violations of your code. Again, where you define the outlines of your code is going to determine how you answer that question. So if you throw a very broad cover around all kinds of personal conduct type, ethical type things and call that as your code, when somebody asks you, have you had any violations of your code of ethics, it's going to be hard to say, well, I had these kind of violations, but I'm not really going to tell you about those other things. So there's again, kind of an intuitive, clean approach of saying code of ethics is personal trading. If you'd like to know about issues around personal trading, we'll tell you about issues around personal trading, and we're going to use code of ethics as our shared proxy for how to describe that. But again, in this case, there may not be a right or wrong, but there are some different implications in terms of working with your clients or potentially mutual fund clients as well.
Yeah, I think from our perspective at my firm, since we're a smaller shop and we're only managing assets for high net worth individuals and businesses, we take a little different approach. We do include gifts and entertainment, political contributions, and those types of items in our actual code of ethics. But in our code of ethics, we give kind of the basics, the must-haves, and then we have a separate document that covers the nitty-gritty of our personal trading policy, the process of how you pre-clear and how you report. So I think that might be a little different, again, because as Kevin said, we're not involved with managing mutual funds. And I also only have 30 employees, so a little different perspective. In terms of the elevation or escalation of violations, that's something that we have discussions about at our firm. The good news is because we're small, I'm able to easily speak with senior management. So if we do have some issues with an employee or general code items that need to be clarified, it's very easy for me to have a conversation with my senior management, and therefore we can work through defining really a violation versus maybe an error within something that could or could not be reportable.
Yeah, this is an interesting one. We certainly have seen different codes over the years that get into some of the process some of the things that Gretchen mentioned, and some shops do include a lot of some of that granular nitty-gritty workflow in their code itself, or maybe in an appendix to their code. Other shops may say, here's my policies, but then have a separate document or separate advice to their staff so that they know logistically what's expected of them. The other comment here about violations and interpretive questions is quite interesting, because on one hand, the SEC might prefer you to have fairly prescriptive, quote unquote, procedures, so they can see that you have a well-defined escalation process and you've thought through all the questions and potential issues. That may or may not be feasible. From a compliance professional point of view, though, I think one of the important things to think about is, where do you go when there are escalation points? Who do you report to when there is an issue? Who do you consult with when there's a question? Are you authorized to make a call on your own? Or is this something you need to work with some sort of a compliance committee or a governance structure to opine? Frankly, there is a little bit of personal liability here if you go out on your own and make calls on your own. So there might be some wisdom in knowing that when there is an interpretive question, the quote unquote firm opines because you've gotten the compliance committee together to opine. But how much granularity you put in your code itself is a question. Now, we typically don't put an awful lot of granularity in our code. We more think of principles, and then we establish kind of who has overarching authority to administer and interpret it. But we tend not to try to pre-identify particular fact scenarios and come up with prescriptive workflows or procedures that might address those types of scenarios.
I think you make a good point there, Kevin. And I think just as we started hearing both Kevin's perspective and Gretchen's perspective, think about the code, it's really tailored to your particular business model. But it also is thinking about it from a compliance standpoint. You have to administer this. And so however you structure it, you need to be aware of what I used to call sort of the bliss and burden of design, right? So if you create too detailed a structure in your code, that increases the burden of your administrative activities around what you're trying to facilitate. I think as Sara talked, overarching part, where we're talking conduct as a whole, then if you're really thinking about this as a code of ethics addressing conduct, there are certain activities of your employees that will sort of bubble into a violation of conduct, depending on what it entails. And where do you cover that, whether it's gift and entertainment in the code or somewhere else? Those are all activities or conduct that you need to be aware of that could become a problem to your overall ethics. So to your point, Kevin, whether you put it in the code itself or not, you still need to be aware of those types of things, because it may lead to something that ends up being a deficiency or disclosable event. When we look at it, or when I look at a firm consultant's perspective, one of the things that I try to look at is, what's the business model? So what are going back to your risk, what are the conduct risks associated with the way the firm is structured, and where to identify and address those? So whether it's in the code or outside of it, I'm still looking for some mechanism that the firm is using to stay abreast of that type of activity.
Actually, from a drafting perspective, that's a really crucial point, is that if you make this overcomplicated and difficult to administer, you're going to create problems for yourself. And those problems might not have a direct relationship to the policy objectives of the code. You've just created process problems for yourself. I guess the other thought that I'll throw in here while I think about it is, remember that your code isn't just for you. Your staff has to actually understand what you mean. So you shouldn't need a law degree to understand what the code expects of your staff. So plain English, huge. Bullet points, layout, organization, huge. So those kind of things, just as a drafting mechanism, you can never think of yourself as the audience here. You have to think of yourself as the vehicle, but you have to think of the audience really as potentially somebody that's never worked in financial services before and is just trying to do the right thing, and you're trying to put them in a position to succeed.
It's a good
And
point, Kevin, because, sorry, I was going to say that getting back to just the idea, Kevin, where we assume that our employees understand what's misleading or what's, potentially fraudulent activity, but under the advisor structure, what we consider to be fraudulent isn't as obvious to our employees, because types of what were normal activities that in the vein of what we provide our clients could be construed as fraudulent. You fail to disclose, fail to monitor, or whatever that may be. So I think that education piece, which I think we'll get to, is really key in making sure that, to your point, not only do you understand it and your team, but the employees understand what that means to their activities.
And I guess one other sort of detail versus general point would be, not only is it confusing to your employees, perhaps with too much detail, and I think earlier there was a point about, the SEC might want to see. At the same time, the SEC may want to see some detail. The more detail you put in, the more risk you have of gotcha kind of violations, which is also a risk. And so I think that's also a thing to think about when you're drafting and deciding how much to put into your code. Because if you put things in the code that aren't really required, it may be helpful for sort of the process, but it also gives the SEC another place where they might come in and look at that piece, even if it's not a required piece. So, what if you're a global asset manager and you're required in another jurisdiction to have something in that jurisdiction's version of a code of ethics? Do you put it all in one code of ethics, and then you have two different regulators looking at one document not really designed for either of them? So those are, I think, considerations too.
Right.
Yeah, and that's a critical point, and that's a good reason why, for example, my shop, we don't put our gifts and entertainment policy in our code, because we want our gifts and entertainment policy to be reflective of local market practice, and our folks in London and Singapore might have different practices and regulations than our folks in the US. So for us, we try to keep our personal trading policy as consistent as we can, but things like gifts and entertainment, there are differences.
Yeah, my
Gretchen,
suggestion
please.
In terms of, no problem. I was just going to go back to sort of the process and the procedures. I highly recommend that you keep notes for yourself, and if you keep a log of any types of violations, errors, however you classify them, try to keep your types of violations in separate lists. In case you get an audit, then you only have to show that portion that they're asking for. So for instance, we are under an SEC audit in the cybersecurity area, and it's been very nice. I know this is sort of a different area, but in the training area, I'm able to give them just my training that was in regards to cybersecurity, because I have broken that out. So in this situation too, I think that's beneficial. So if you need to answer a question about gifts and entertainment or trading, you can give just that information and not give more than you necessarily need to.
If I could, I want to come back to something, Kevin, you were talking about. It's on this slide at the very bottom, which is the escalation C. And as a consultant, when we look at codes, oftentimes this is an area of drafting where people are very sort of abbreviated on, you'll be reported so or whatever, and a lot of really definition to help an individual understand what that's like. And I think you make a really good point earlier, Kevin, about who decides, who interprets, who determines. And I think for compliance professionals, recognize this is an opportunity for you to not be left on an island and to utilize resources within management about, is it really my call, or is it a committee's call, or is it else who helps makes these decisions, so that it is something where there's a bit of shared risk. Because to your point, Kevin, there's a lot of liability in making type of implementations, and whether there's a process for you to say, when do we bring general counsel in, when would we escalate this maybe to our outside counsel, have that conversation can help you if an event occurs of saying, here's how we go through the process to get to a conclusion. Would you agree? I mean, I'm just trying to think of that. I think that process is important for everyone to understand.
I do think that's important, but this goes back to what your particular business model and culture and environment is. I think it's probably bad career form to go to your boss or your outside counsel every time you have a question on personal trading, right? So at some point, our organizations have bestowed us with this grand responsibility of being adults and making decisions. So there is some decision making and some judgment here. Clearly you can and should use those resources when it's appropriate, but you shouldn't also view that as your only choice. Even if you make a call on your own that you think is a tweener, then you put a note in your own notes. So if somebody comes back and asks you, you can show that you were thoughtful at the time. But that actually brings me to another point that I think we need to acknowledge a little bit, is that violations are not all created equal. And even the definitions or the kind of standard nomenclature of material and immaterial, it typically doesn't really address the real world. Even within immaterial, there's a wide range of things. And that's one of the challenges, just being a practitioner, the pragmatic, the interpersonal aspect of this. The question when you're sitting or talking to somebody directly who's had a violation and you know that they didn't do anything wrong, it was their spouse or they did something mistakenly. Well, that's different than doing something that was maybe they were trying to play it close to the edge or whatever. Those things are data elements that you need to take into account as you figure out what the correct response is. But those things can also then become very difficult when you're asked by a regulator or by a client to report all violations. And did you have any material violations? Again, this isn't crime and punishment. This is personal trading and investment compliance, right? So as I tell people, look, my job isn't here to go and find people that I can shoot at dawn. My job is to find things before a regulator does and to try to be thoughtful about identifying things and creating a good record so that when somebody does come and ask, we can show that we've been thoughtful about addressing and mitigating our risks. And again, I'd rather have that discussion with an individual and understand their thoughts and their perspectives before determining what sort of response is appropriate. And I reserve the right to change my response depending on the facts and circumstances, even though between two different immaterial violations, they might both show as immaterial. The one might get a more personal visit from me and we might do a little more remedial training, whereas the other one might be a little more, hey, I know what you're trying to do here. You just need to be a little more careful next time. It's all good. And we declare victory and move on. But I think those kind of things as a practitioner, those things really exist outside of the four corners of the document of the Code of Ethics itself. But those things probably present the most day-to-day challenges and the most difficulty, just kind of quote unquote in the real world.
Okay, I'm going to be the moderator here and make us move on. We have a lot to cover today. So before we move on to our next topic, can we show the polling results from our first question? So big percentage, right? We see that almost everyone here, we have 78% do include gift and entertainment policy. So that's interesting. Hopefully this discussion helps you think about whether that's how you want to continue or other areas. So let's move on to our next issue, which is access persons. So at a very general level, as you all know, an access person is an employee who has access to non-public information about a client's securities or who's involved generally in making securities recommendations to a client. The definition generally is designed to get at those who would have information and the ability to be caught up in the kind of conflicts that the Code of Ethics is designed to address. So we have another polling question. How frequently do you review your list of access persons? And again, while we wait for you to have a chance to answer that question, we will go on and discuss some issues around access persons. So we don't have a slide on that actually, but let's talk about issues that arise for you in reviewing access persons and tools to administer lists sort of access persons.
Yeah, this is another one. It really depends an awful lot on your business model. As Gretchen says, if she's got 30 people, it's probably a little easier to keep track of who's coming and who's going and to figure out who has access to what systems. For a shop of larger size, you probably need something that's a little more scalable, repeatable, a process, need some objective lines to be drawn or potentially not drawn. Again, depends entirely on your business model. There are certainly some shops that have a lot of internal walls or barriers that says this group only does this, so they don't need access to these systems and this information. And if that's you, then you have some objective ways to be able to draw lines and say this group is maybe outside of that scope. But as this polling question really gets into, it's not just a question of changing individuals. You also should revisit your assumptions and your methodology of drawing those lines periodically. But it can be difficult to get plugged into the HR group, both people joining the firm and leaving the firm, but also internal transfers. How do you keep up with those kind of things? The problem or the challenge here is that if you have somebody that becomes an access person, there is a clock that starts ticking in terms of when you get disclosures of brokerage accounts and those kind of things. So it is something that's worth keeping an eye on. Another thought that I'll throw out before I forget it completely is don't forget about removing access persons. We're as compliance professionals, we always tend to really focus on making sure that the people that need to be in the party get invited and get pulled into the party. But sometimes we don't focus as much on people that have left the party. In former years, that may have just been a bit of a nuisance, but it's probably good form for departing employees to show that you're thoughtful about no longer receiving their information, their duplicate statements and confirms. But as privacy laws start to become more of a thing for investment advisors, there's a concept of only keeping that personal information which you have legal reason to or legal need to. So if your former employee was an access person and you haven't turned off the ability to get duplicate confirms and statements for their personal accounts, you might actually be receiving a lot more information from somebody you don't have much of a legal basis to anymore. So this is a question that from a couple of different perspectives does warrant some time and attention, even though it might not always get the headlines.
I just have a quick comment in regards to defining your access persons. Again, because we're a smaller firm, everyone at our firm is deemed an access person because we have lots of discussions about clients and our process and our investments. So we feel that that is the best way to operate. And we have for several summers had interns, and we just have made sure that we go through the training process and get the information that we need because we do deem them access persons as well. So in addition to sort of the standard comments about consultants and contractors and such, make sure that you're thinking about some of those people too that you bring in even for a part-time basis.
This is actually really interesting.
Yeah, I was going to say, Kevin, that's a really good point.
Yeah, it's an interesting practice tip or practice comment because I do think there are different approaches to the question of shorter term guests, whether it be interns or contractors. We take the approach of if it really is short term, we bind them with confidentiality agreements and scare them about all the big and gory things that means. But we don't actually call them access people because trying to get duplicate confirms and get reporting of things for somebody that's only going to be with you for a short period of time is an administrative cost and burden. And our typical or our traditional view is you have to weigh the costs of that with the with the policy objectives. So we try to make some objective cuts. If you're a contractor and you're going to be with us for a longer term, I reserve the right to call you an access person and bring you in. There are some scary things about that for those of you that are wise in the ways of human resources laws. If you treat your independent contractors in similar ways as you treat your employees, that could create some other challenges. Gretchen and I are both sitting here in the great state of California, which takes a fairly dim view of the line between contractors and employees. So, how you treat contractors is maybe something that you should consider talking with your human resources group before you make calls on your own.
And I think that process, Kevin, is really important. So when making decisions about third party or temporary employees, the analysis through and the decision process, recording that's helpful because, again, it's a thing. And I think part of this is, as Kevin alluded to, is the burden associated with trying to meet the requirement for the period that's going to be associated with the firm may not be cost effective relative to the risk. But that analysis,
Right.
I think, is what and someone having a question around that, because I think, Gretchen, to your point, lots of clients ask us that same question. I've got an intern, or I've got, a temporary person helping us, what should we do? And I think this type of analysis is a good way to frame how you want to approach those types of relationships.
Yeah. Well, and I think, the underlying question is, how do you want to address that within your code?
Mm-hmm.
So.
Absolutely. That's the standard exam tip, right? Make a policy, state your policy, abide by your policy, declare victory, something like that.
Yeah.
Sara, what do you think?
Like
Do we have poll results?
Let's see what our poll results are here. Okay, so we don't see a lot of limited employee trades. That's interesting. Great. All right, so let us move on. If I can get that to happen, to some current key issues that are important and interesting right now. So I think one question is, have you all done anything different in light of sort of our work from home environment and the whole COVID issues around your code of ethics?
So our firm has, you want me to go ahead first?
Okay.
Our firm has decided, we decided that since we have such a collaborative environment, that probably about 4 or 5 weeks after we went out last year, we decided to call an all staff meeting every other week. And during that time, we've touched on some general training items. As Kevin mentioned, in I think a lot of our areas, whether it's been mandated by the state or the county, we've had to do COVID training as well. So we've incorporated that. We've tried not to do too much intensive training through online platforms because I think everybody is just sort of feeling like there's so much online now. So we've really utilized that more. Face-to-face is not exactly what we're getting in a Zoom call for our staff meetings, but it's a little more at ease and an environment where we can talk about some of the hot topics and touch upon things that have come up during the absence of being in the office.
Yeah, training has been key, but as Gretchen absolutely notes, people have screen fatigue, people have input fatigue. There's just so many inputs and so much drama that to have your compliance person jump up and down and say, hey, remember this particular thing that happens to be important to me, it may not be the best use of your own political capital and goodwill. So we certainly emphasize some things in various trainings. We put out some little email reminders and notes. We've modified some of our annual compliance training content this year. So we've really put the word out, but I'll say more broadly around all the remote working. Our biggest emphasis has really been just making sure that people know that they can come ask questions, whether it's personal trading or anything else. It's not going to be the time to retrain everybody and revalidate everybody's understanding of all of your technical rules. But if they remember nothing else other than it's okay to call you if they have a question before they do something, that's a reasonable takeaway. There's obviously a potential downside if everybody calls you before they do every little thing. That's not good either. So you still need to treat people as adults and show them to the resources you have. But I say the general concept of it's okay to ask, especially around personal trading, is not so bad to reemphasize. Should we talk a little bit about market volatility and some of the code there? Where the SEC had some concerns about some things around whether it be trading for client accounts or personal trading, things like that. We took the approach of number one, as I said, emphasizing just being available, answering questions, particularly in late March and early April last year when the market was so volatile. Our trading volumes, our personal trading volumes went through the roof. The number of questions that we were getting every day was going through the roof. We didn't that was obviously our first priority was to be able to answer our staff questions. But one of the things that we actually did is we kept everything in our code constant, but we do have a max number of trades per quarter for our staff. It's kind of a time and attention type of a thing, and we actually lifted that threshold during the times of market drama. And from a policy objective, we thought we were able to continue to address the policy objectives, but we wanted to give our staff the latitude to be able to manage their personal affairs. And frankly, from a morale point of view, we were able to remove one stressor from their lives and allow them to again manage their personal affairs in a way that we didn't think had much of an impact on the overall policy objectives that underlie the code of ethics.
Okay, so let's also talk about beneficial ownership. One issue that obviously can come up is whoops, lost my slide. How you would deal with the securities and access person has to provide transaction reports on. So how would you address this scenario? You have an employee whose mother's going to be moving in with the employee. This obviously is something that could have happened recently in this situation that we're in. So how do you deal with this situation? Let's talk about this. We are not doing a polling question on this. We're just going to have a conversation around it.
As I said before, this is a good example of where
and how do you define beneficial ownership? Sorry to start off the conversation.
Yeah, say beneficial ownership is a fairly broad net. So if you've got people in your household and you have some influence or some control, that you really get into the weeds pretty quickly in terms of what the definition says and what your facts and circumstances are. So as I mentioned before, the challenges of code of ethics really aren't usually within the four corners of the document. It's things like this where mom's had her FA for 2 decades and she's now living back with under the roof of your employee, and you're faced with this decision. Do you need to be the bad guy to tell mom that mom needs to change her brokerage account or FA just to make your life easier? I'll tell you, I'm not really inclined to make mom move, but I'm going to ask some questions to be able to be informed as I make that decision. So if mom's a day trader, that's going to be a different fact pattern than if mom never trades. Even better if mom has a brokerage account, but her FA has full discretion over managing the portfolio. I might ask some questions, things like that, which give us a better sense. Is this a temporary thing? Is this vignette here says several months, plans to move in for several months? Really, if this is a 2-month thing, is it really worth all of the gymnastics if your risks are very low and your administrative burden is high? And again, you're going to tell mom to change her FA? Maybe not. But if mom is moving in and mom's a day trader, maybe it is. This is another thing where maybe you tell your employee, hey, right now, this is how we're going to approach it, but I'm going to put a reminder on my calendar. We're going to revisit this in a month or two, and you're going to tell me if anything's changed, because maybe mom was only intending to hang out for a couple of weeks, and it's turned into mom is going to be around for a longer period of time. Those are facts that you're going to have to evaluate as you figure out how to actually administer the code.
Right. We had two similar situations at our firm that we had discussions about. One was adult children that are in college that have moved back home during this time that we all have been at home. That was something that we discussed at our firm and how to, handle their personal trading. And then also the situation of unmarried partners living in the same home. And that's totally a wording issue in our code of ethics. So we have had some discussions about making sure that the way that we address who is included in the group of beneficial owners / supervised persons, access persons. We make sure that that's all covered so that we're capturing the right people.
It's a really difficult. Yeah, go ahead, Kurt.
I was going to step in just briefly because I saw a couple of questions coming in. I think the key here, as you're talking about, Gretchen, is how you define it in your code. And coming back to you, Kevin, when you're looking at who's a beneficial owner, what's the relationship, what's the circumstance. So if we go through that waterfall to help get you to the decision making, there's a comment about roommates and things like that. And you have to remember, if it's not a relation, meaning it's a person you're sharing a dwelling with, but you're not related to them, you don't have maybe a partner relationship with them either, there may be distance there. There's other policies that may come into play versus your personal trading. You might have confidential information. You might want to talk to the employee about their work environment in their home to make sure that they're restricting the access to that type of information. It wouldn't bubble up to a personal security situation. It might just be, hey, how are you working? Where do you store the information related to business? Is it on a computer? Is it away from your roommate's access? That's a different thing. And again, it's kind of what you were saying before, Kevin, that's not a code of ethics thing necessarily. It might be covered some other way. But I think those are all things that are relevant. I would suggest, and part of what we look at when working from an audit standpoint with it, is how do you get to the point of making the decision of whether they're in or out, and what's the documentation you have to support that, right? So you can have all the conversations you want with mom and the employee about what the mother situation is, but I'm going to be looking for some record that I can go then and pull and say, oh, here's how it was assessed, this is the decision, so that I can at least go back and say there was thought put into not include person, and I can be able to verify that in a way that shows that you've kept a record of it.
Yeah, good point. Yeah.
Sara, should we go back and it looks like we have some people that are interested in talking about classifications of access people and some of the pros and cons of some of those nets. So it looks like that may be a question that some people have questions about. I'll pick up with one just to get us started. There's somebody that was looking for problems or issues with treating all employees as supervised and access persons. I guess that could go in a couple of different directions. The headline to me, let's just, I guess, start big picture is, the pro of including all of your folks as access people is it's a simpler story to tell for your staff or clients, that everybody is kind of part of the same part administratively. You hive off certain parts of your or certain groups, then you have those carve outs and those kind of things. That's a bit of an administrative burden. The downside of including everybody, in addition to the downside of including everybody, is you potentially might be generating violations for people that have no business being viewed as access people. And frankly, you're not going to get a whole lot of extra credit for creating violations for people that didn't need to be in the mix to begin with. So there is definitely a potential downside there to throwing that net too broadly. But the way that our starting point is we presume everybody is an access person, and that's partially because of our business model, where we have kind of looked at what systems access people have, and what kind of normal day-to-day cadence of information sharing across the firm is. A different shop might look at some of their access permissions and some of the sharing of information and come to a different conclusion, but that was our starting point, is really looking and seeing how much information is available and how much is kind of broadly accessible across the firm.
So another question going back a little bit earlier, if you don't include things like gifts and entertainments or political contributions in your code, where do you put those? Do you put them somewhere else in your compliance manual? Do you have a separate policy? How do you address that?
We just put it elsewhere in our compliance manual. So it's no different than we have a compliance policy on outside business activities and one on political contributions and one on gifts and entertainment. And so it's just another policy.
Same.
Somebody, it looks like somebody also wants to ask about material violations, what a material violation means. And this is one that, again, I think reasonable people can come up with their own approaches and their own distinctions. The way that I've typically understood it and heard it articulated is material has a couple of different possibilities. One is where somebody is actually trying to evade the purposes and the policy of the code, even if it doesn't actually have an impact on client accounts. If they're really trying to play games and do something intentional, that's not a great fact pattern. It's hard to call that anything other than material, because you certainly can't call it an administrative foot fault or a process issue if they're really trying to play games. The second one would be is if there is an actual overlap between what an employee is doing and what the firm is doing in client accounts. This one, again, I do think you get into a little bit of facts and circumstances where it's more likely to be material if the individual was closer to the portfolio, closer to the trading decision, maybe a little less if they were further away and realistically had no touch. But the closer you get to a potential overlap there of a failure to pre-clear where pre-clearance would have not been granted because there was activity, that starts to get a little more difficult. There's also a question of magnitude in terms of some of these things. Maybe a exceeding a max number of trades in a quarter. If it's a handful of trades, okay, maybe that's a process thing that you could have counted more sharply. But if your person has a recidivist habit of regularly going over that amount, and it's the third quarter in a row, and they're 50% above your threshold, again, it's kind of hard to call that just an administrative foot fault, good faith error. So that's probably a lot of words, but I try to make some distinctions between intent and no intent, process, administrative foot faults, and things that actually get to the underlying conflict objectives of the code.
So we have a question about digital assets, and that was actually a topic we had here. So the question was, what are thoughts on pre-clearance of digital assets that may qualify as digital securities? Is this a wait-and-see regulatory situation? What's your policy with regard to digital assets to your employees? Are they permitted? Are there prohibitions?
So my general rule is if you're using it as a security, right? You want to buy low, sell high, you better be pre-clearing it. I made that clear at my firm.
We have a little more of a wait and see approach where we are not trading digital assets in client accounts. We have no conflicts there in terms of what my folks might be doing in their personal lives and what we're doing for clients. So our advice is to kind of be cautious and don't be stupid, but at the same time, we're not requiring reporting of digital accounts, crypto wallets, or all that kind of stuff, and we're not requiring pre-clearance or reporting of individual transactions. But it's no question it's a wait and see. But as we started off at the top, we also said your business model is going to dictate if you're doing digital for your clients. It doesn't really matter whether it's a security or not. It's probably something that you need to include because the SEC is going to say, hey, you have a possibility of a conflict there that you need to identify and address.
Yeah, so I think you make a good point there, Kevin. We talk about the source right now, and I'm sure depending on who comes into the new administration here, there'll be some additional digital assets. There was a recent risk alert issued on this. It didn't talk specifically about the code of ethics relation to digital assets. However, I thought a telling point in that risk alert was talking about our friends across the fence in FINRA and registered rep participation in this. And I think the real key here, an advisor perspective, is if your advisor, especially client-facing ones, are dabbling their toe in digital space, is making sure you don't have an outside business activity associated with what they're doing. Since it is an investment-related activity, you want to make sure that they understand and that's going to be personal. It stays personal and doesn't come into the client conversations or the client service aspect of what you're doing for them. And so that's more of where I'm concerned in working with clients saying, hey, if you've got a portfolio manager that's doing some Bitcoin stuff or whatever, is he talking about that with your clients? Even if it's his personal stuff, because they're viewed as an expert, they're viewed as an advisor, and even if it's a casual conversation, that still has weight. And that's where I would get more concerned about this. And as Kat, it's not defined yet, but there's still some risk there to just be monitoring as this gets a little bit more clarity to it.
Yeah, and the practical question here for those like Gretchen who are asking her employees to tell her about it, you have to give them some guidance. Do you want Bitcoin, but you don't want Dogecoin? I mean, there's 100 different coins and tokens. So do you want every little thing that could be viewed as a token? Or do you say, look, these are the 3 or 4 biggest ones that seem to be most potentially relevant. Tell us about those, and the rest of them you can, continue doing your own thing. But hey, staff, we may change our approach going forward. This is an area that's subject to change, so stay tuned.
Again, I think that you're responsible for setting your tone at your firm, and as Kevin mentioned, if you make it apparent to your staff that you're available to talk about these situations, they're going to come to you before something happens. I mean, the thing that's so great about my firm is everyone's very compliant. Nobody wants to get us in trouble with any of the regulators. So we tend to get a lot of questions around sort of outlying things that aren't necessarily covered in one of our policies. And that allows us to create some discussion and then create a policy where it's necessary.
Yeah, and I was just going to throw in on the digital assets, with Gary Gensler presumably coming in as chairman, he has experience and has been teaching a course on fintech. So, hard to know which way that goes. I think in his testimony yesterday, he basically said, there's a lot of innovation in this space, but we have to watch out for investor protection. So, he kind of threaded that needle. But we may see some more guidance coming out from the administration. We have a bunch of questions, and I don't want to leave anyone's out, but I don't think we're going to have time to answer all of them. One, I think we sort of touched on it, but not in the context of GameStop. One person was asking whether GameStop triggered any compliance issues with your firm. I think we talked about sort of the frequent trading, but was there anything more anyone wanted to add on that particular issue?
The biggest question we had is the one that Gretchen identified, where we have college age kids of employees that all want to get into Robinhood and be billionaires overnight. So that, frankly, it's not really a GameStop issue, but it really brought that issue to a point.
And I think just the overarching here, Sarah, is that remember your employees' obligations is to your clients first, and half their time during the day on apps trying to get involved in these types of spikes. That are they really servicing the clients the way they're supposed to? So it's certainly an onion you're peeling back, or a pickle you can delve in.
We have a minimum holding period in our code of ethics of 30 days for equities. It doesn't matter. I mentioned we're a fixed income shop, so it doesn't matter whether we have exposure to that name or we're trading in that instrument, but we have a minimum 30-day holding period. And part of the reason for that is if the SEC comes and asks us about insider trading risk, about day trading risk, those kind of things, that is one of our controls. So I suppose the GameStop world might be an area that we would point to the holding period as a way of mitigating some of that risk. But again, that existed pre-GameStop and it'll exist post-GameStop in our code. It wasn't specifically designed for that scenario, but it gives us a story to tell if we're asked about it.
So we just have a couple of minutes left. I wanted to just give everyone a chance to kind of go do just a round robin with any other key takeaway that they haven't been able to get to in our conversation, or to answer a question, whichever they prefer. Gretchen, why don't we start with you?
Sure. There were a couple questions that were posted. One was very specific about buying and selling the same day as clients, and blackout lists and prohibited lists. That is so firm specific as to your practice and what you, how you're trading with your client accounts. I would really suggest to anyone that they feel that they need to have more limited policies is to sort of do some research or test the policy to see if a more restrictive policy could work at your firm, or as Kevin has mentioned, if that's going to create more work for you, there's going to be an added cost involved. Our firm uses a third-party resource for capturing all employee trades, pre-clearance, attestations, all those types of things. So if your firm is in a situation where you have a more limited policy, you might want to consider something like that.
Great. Kurt, you want to give us a last word? Oh, sorry, go ahead. Kevin, you can give your last word.
Yeah, my two headlines would be, number one, always know the source of authority. There are some things that come from the SEC rules themselves or SEC best practices. There's other things that have been voluntarily adapted over time within the industry. So if you're going to be making interpretive decisions or even potential changes, make sure that you can trace back to the source of authority so you know why those particular provisions are in your code and how much flexibility you have. The other related thing I'll tell you is that typically restrictions ratchet one way. So if you want to go more restrictive, just remember that it might be difficult to make it less restrictive at a future point. So just trying to be thoughtful. I love Gretchen's thought about pre-testing your potential changes before you actually roll them out, so you have some idea of what the fallout might be. That will pay off in dividends, both in terms of the design of your procedure, but also in terms of diplomacy. So if you do some pre-review and you find out of all of your staff, there's just one or two that are going to be impacted, you can go to those people ahead of time and talk to them and kind of manage their expectations and smooth your rollout.
Great. And Kurt, last word.
Yeah, I was going to say, I'll just add another tool for those of you that are listening. And when we were talking about beneficial accounts or accounts that are being managed for employees or other family members, if they tell you that it's being managed by another party or that they don't have direct access to it, there's a really good IM that came out in June of 2015 that has a series of questions to ask that kind of go beyond just getting the employee's work. But I think it's real to ask those questions of the employee about, whether the third FA have Gretchen and how often they talk to them and things like that. So I know we don't have time to get into it, but I just want to point to that since we covered it a little bit during this session.
Great. Thank you all so much for joining us. Thank you so much to my panelists for a really insightful and interesting hour. And please enjoy the rest of the conference.